So the world of investing can get a little overwhelming, especially if you're just beginning. It's almost like learning a completely different language with all this jargon thrown around like bear market, bull market,
asset allocation, liquidity, price to earnings ratio, annualized rate of return.
But don't worry, if those terms scare you like it does me or make your head spin, we're not going over any of that in this video. Instead, we'll be talking about 3 different types of investments that you can put your money into.
And those are mutual funds, index funds, and ETFs. And if you're not familiar with ETFs, they just stand for exchange traded funds. So all these investments have one thing in common, and that is they hold a bunch of stocks within them. So when you buy into either a mutual fund, an index fund, or an ETF, you're buying into something that holds a lot of other things within it. But is there a difference among the 3, and is one better than the other ones? That's exactly what we're going to be talking about today. What's up, guys? I'm Mike.
And I'm Brit.
And let's get into it, starting with mutual funds.
Mutual funds are the oldest of the 3 types of investments we'll be talking about today in this video. It's unclear exactly when the first mutual fund was created. Some historians think it happened in the mid-1800s, while others think it might have been the late 1700s. But the ones we're familiar with today, according to Investopedia.com, were created in the 1920s.
So what are mutual funds? Well, they're a type of investment that a lot of people pool their money into all together and fund mutually, hence the name mutual funds. The goal, just like any other investment, is to grow your money over time. Turn $100 into $1,000, for example. Typically, mutual funds have a ton of money in them. Billions of dollars or tens of billions of dollars is not uncommon for mutual funds to have. Because of this, there is a manager kind of overseeing everything. Sometimes there are multiple managers. These managers oversee the day-to-day operations and make sure things are going smoothly and the fund is growing how it's supposed to. There are really 2 types of mutual funds. One is called actively managed, the other is called passively managed. Actively managed mutual funds try and outpace the market. So for example, the S&P 500's rate of return for the last 90 years has been 9.8% on average. Well, a mutual fund manager that is actively managing a fund will try and get 12%, 15% year over year. So the fund managers are buying and selling stocks pretty much continuously. Passively managed mutual funds, on the other hand, there's very little trading going on, and those are meant to just kind of track the sector of the market that they're in.
Some pros of mutual funds are you're buying into something that's already well diversified, and the fund managers are very intelligent, especially when it comes to finance.
You can also just sit back and relax and let the fund do its thing without you having to put in any type of effort and energy into market research, researching the stocks that are within the fund itself. You can just let the managers handle all that for you. So let's focus on actively managed mutual funds while we're talking about the cons of mutual funds real quick. A big con of actively managed mutual funds is it normally requires a higher initial investment to get into them. So anywhere between like $1,000 up to millions of dollars, for example. Another con of actively managed mutual funds is that they have much higher fees because there's people actively managing them day in and day out, trying to beat the market and get as high of a return as possible. The investor can be charged fees either at the initial investment. This is called like a front load fee. These generally are around 5% or so. If there's no front load fee, the mutual fund is called a no load. The fees are generally higher year over year in terms of their expense ratio. What an expense ratio is just kind of like a little bit that's taken off of the earnings of the investor that's paid to the fund managers to keep the fund going and actively manage it. What this ends up doing, however, and this is another con, is it eats up into the investor's compound interest year over year. So a lot of the no-load mutual funds that I've researched myself that are actively managed have expense ratios of 1.5% to 2%. It's not uncommon. So for example, if you invest a lot of money initially into a no-load mutual fund with an expense ratio of 2% per year, 40 or 50 years later, by the time you retire, up to 2/3 of what you could have earned in that fund in interest will be eaten away by the expense ratios and paid out to other people who are managing the fund, which is, in my opinion, a big disservice to the investor. A lot of your wealth is going to be taken away by those expense ratios. Same thing with front load fees. 5% of an initial investment is pretty big. So like if you're investing $100,000 into a fund, you're paying $5,000 up front to somebody else. You know, that $5,000 could have also grown at whatever the rate of return is for that fund, but instead is being paid to somebody else. Which kind of leads to an interesting point. If the fund is going to outpace the market or the sector of the market that it's in, then it's probably worth it. However, it's extremely difficult to outperform the market because of the simple fact that nobody knows what the future is going to bring. Let's say you buy into a fund that has done incredible for the past few years because it has just a manager who's on top of everything, knows what they're doing, on it 100%. Well, just because that manager is running the fund when you buy into it doesn't mean they're going to be running it next year or the year after. They could move and another manager could come in and take their place who doesn't know what the heck they're doing. So just because a mutual fund is doing really well one year doesn't guarantee it's going to do really well the next year or the year following. And just because a mutual fund has done really well in the past decade doesn't mean it's going to do really well the decade following now.
Another con of actively managed mutual funds is a higher tax bill if it's outside of a retirement account. And this is due to the high amount of trades that take place in this type of account.
So let's go over some examples of actively managed mutual funds real quick. These are both going to be Morgan Stanley Inside funds, but the first one's symbol is CPAOX. This is a front load fund, meaning you pay 5.25% of the initial investment to the manager, and then this one has an expense ratio of 1.17% per year after that. The minimum to invest is $2,500, and its average return since inception, load adjusted, meaning the front load is taken into account, is 11.62%. The next one is also an actively managed mutual fund. It's CPODX. This one does not have any front load. This would be what's called as a no load mutual fund. Its expense ratio is 0.91% per year. The minimum amount to invest in this one is $5 million, and it has an average return of 12.13% since inception. And I don't think this accounts for the expense ratio of 0.91% per year. I could be wrong, but I don't think it does. So if Brittany and I were investing into an actively managed mutual fund, we would be very cautious about doing so. We would be very careful. We would do a lot of research up front into the fund itself, because the last thing we would want to do is buy into a fund that's overpriced and underperforms, because we could be potentially losing hundreds of thousands, if not millions of dollars over the course of 40 or 50 years. Okay, so we've talked a lot about actively managed mutual funds. What about passively managed mutual funds? Well, passively managed means the fund manager is not actively trying to pick and trade stocks to maximize returns. They're just trying to track what's called an exchange index. The most widely known exchange index would probably be the S&P 500. These are what's called index funds. So index funds were created by a guy named Jack Bogle back in the 1970s as a way to try and get around all the high fees and underperformance of most of the actively managed mutual funds. He was kind of sick and tired of these fund managers charging investors such high commissions and expense ratios for a fund that would most likely not perform how it was supposed to, given how much you had to pay to get into it.
Some pros to index funds are there's a very low fee, anywhere from 0.01% to 0.25%, which is really great compared to the 0.9% all the way up to 2% we talked about earlier for actively managed mutual funds. And also there's a lower minimum investment, anywhere from just $1 to get started.
So one con of index funds would be that they can only be bought and sold at one particular time per day, and that's after market close at 4 p.m. Eastern. This is also true with actively managed mutual funds. Another potential con of index funds is that some people see them as having less downside protection. So for example, since index funds are only tracking an index, whatever happens in that index is going to be what happens with the index fund. So if the index that the index fund is tracking tanks, the S&P 500 for example recently, then the index fund is going to tank as well. Actively managed mutual funds, on the other hand, can sometimes have a little bit more diversity built into them, which would give them a little less of downside risk compared to the market. An example of an index fund would be what's called the Fidelity 500 Index, or the FXAIX. This has no initial fees. It has an expense ratio of 0.015% per year, incredible compared to actively managed mutual funds. Minimum investment of $0, and an average return since inception of 10.22%. So comparing this to the S&P 500, for example, for the last 90 years, on average, the S&P 500 as an index has returned about 9.8% per year.
The last type of investment we'll be talking about are ETFs, which are exchange traded funds. And these are similar to index funds, except you can exchange them in the open market, just similar to stocks. And you're not limited to just buying or selling one time a day like you would be with index funds.
The first American ETF was created in 1993, and that was called the S&P 500 Trust ETF, otherwise known as SPDR, otherwise known as SPDR. The SPDR fund became extremely popular, and over the next decade or so spawned a lot of other ETFs to be created, and started creating this competition between ETFs and mutual funds as to which category could get the most amount of people's money. And I think it was like by 2003, ETFs outpaced mutual funds in terms of like the cash flow that was going into them year over year. I think now they're more or less the same. Sometimes mutual funds win, sometimes ETFs win, but ETFs became extremely popular in the late 90s and early 2000s. Something else about ETFs is that you buy and sell them like you would a stock, even though ETFs are not stocks. They have a certain price to them, and the price goes up and down, fluctuates with the market. For example, let's say you want to buy ETF A, and ETF A has a price of $200. You pay $200 for ETF A, and then you have one share of ETF A in your portfolio. And if you want to sell ETF A later on in time, you get whatever the price is at that moment in time.
Some pros of ETFs are basically all the pros that we mentioned about index funds. They have a very low fee associated to them, low minimum investments, and you can buy and sell in the open market.
And depending on who you are, you may view being able to sell these in the open market multiple times a day as a pro, as opposed to regular index funds or actively managed mutual funds. You could just buy and sell them after market close once per day. The flip side of that, however, is that being able to trade them multiple times a day could potentially lead to people wanting to do that and losing money over time. I wouldn't say that's necessarily an intrinsic con of an ETF, but just be aware of your own psychology and how that may play into it. The only other con that ETFs may have, or that I could think of, is that same lack of downside protection that index funds would have, just because they're meant to track an index or whatever kind of sector they're in, and whatever happens to that index or sector, that's pretty much what's going to happen to the ETF. ETFs are my personal favorite investing vehicle. As of right now, these are what Brittany and I are invested most in currently. We may invest in index funds or mutual funds later on in the future, but most of our investments are in ETFs, and we have a few individual stocks here and there. But some examples of ETFs would be VOO, the Vanguard S&P 500 ETF, current price of $299.97. Another one is VTI, the Vanguard Total Stock Market ETF, with a price of $165.77. VUG, the Vanguard Growth ETF, with a price of $215.88. This is just for one share of these ETFs. So, for example, if you wanted to buy one share of VUG, you would pay $250.88. You'd be bought into VUG with one share. Here's one that my wife and I have 10 shares of. It's SPYD, the Spider Portfolio S&P 500 High Dividend ETF with a current price of $28.51. So we've talked about a lot in this video. Let's just briefly review everything real quick. So mutual funds can be broken down into actively managed or passively managed. The goal of the actively managed mutual funds is to try and outpace the market. So there are a lot of stocks that are bought and sold and traded within those funds that could create a higher tax burden potentially for investors. They also have higher fees because the managers are so active within them. Sometimes they end up outpacing the market for decades on end. Sometimes they don't. You just have to be very careful when you're looking and do your due diligence.
And then passively managed mutual funds, which are known as index funds, are just mainly meant to track the market or the sector that they're in.
They have much lower fees and a little bit of less downside protection. ETFs, or exchange traded funds, are pretty much like index funds, very low fees. They track an index or sector of the market, and whatever happens in that sector happens with the ETF. And these are bought and sold on the stock exchange multiple times a day. You can buy in the morning, sell at night if you want to. I wouldn't say that there's a best out there. It's pretty much going to be up to you and what you want out of your investment portfolio, how much risk you can take. If you've made it this far, leave a comment below. Which one do you like the most? Mutual fund, index fund, or ETF? But we hope you guys enjoyed this video. If you did, please give it a huge thumbs up. It helps out the YouTube algorithm tremendously.
And don't forget to follow us on Instagram at It's Mike and Brit for more.
Yep, we post there every now and then. Our Robinhood link is in the description. That's the investment platform that we are using right now. If you sign up to Robinhood using that link, you get a free stock and we get a free stock. That's where you can find a bunch of these ETFs. You could also find them on Fidelity or Vanguard and other places like that, but we personally use Robinhood. Our budget template is also in the description below. It's totally free if you're interested in budgeting or getting started budgeting. You can use our template, no email address required or anything like that. And with that being said, thanks so much for watching again, guys. We'll see you next time.
Bye.